Gold returned into its sideways and muted price action in the most recent sessions, covering up the very important economic updates that took place mostly during the past week. In this report, we will identify the developments that uplifted volatility in the gold market as we attempt to understand what drives gold's price moving forward. Many times in the past, gold's price activity has left clues as to what motivates traders, and our aim is to bring those clues into light. In addition, we plan to support traders with a technical analysis that could prove useful in numerous trading scenarios. My name is Angelos Zitis, and this is the IronFX Gold Report for the 21st of June. On a brief note, the FOMC meeting on the 15th of June proved to be an interesting event for gold traders as the yellow metal was on the move prior and after the release. Gold was on the rise upon announcement of the Fed's 75 basis points rate hike, which lifted the federal funds rate between the 1.5% to 1.75%. The Fed also hinted at further rate hikes looking forward, while it also reiterated its plans to reduce its balance sheet. Characteristic was a paragraph in the FOMC statement that highlighted the invasion of Ukraine by Russia, which was seen as heightening inflationary pressures and hurting global economic activity. A small note on worries over Chinese lockdowns was also inserted, as it could potentially increase supply chain disruptions. During the following daily session on the 16th of June, gold was also on the move, performing its second consecutive session, advancing. Notable U.S. economic data released on the day, including the initial jobless claims, the Philly Fed Business Index, and the housing starts number, pointed to some weakening of the noted sectors. In this case, gold advanced as the news may have temporarily increased economic risk, attracting further buying interest. We must also note the news weakened the USD, as negative economic data tends to lead investors into shorting the dollar. Thus, in this case, we could say the USD's negative correlation to gold was in play in the past week. The major concern for the global economy at the moment are the inflation rates. Even though we are seeing a massive turn on monetary policy towards higher interest rates by some of the biggest central banks of the world, inflation has not been controlled so far and has even surged in recent months. Some market participants doubt whether central banks can actually bring inflation down, as it is mostly derived from higher energy and food prices due to heightened demand and a labor shortage. On the contrary, employment and wages have improved, that may be creating a mixed-up sentiment for the market. The contradicting forces, however, are worth examining closely, as even daily headlines can move gold's prices accordingly. In the following days, a number of economic events unfold that could possibly create opportunities in the gold market. On the 22nd and 23rd of June, we get back-to-back testimonies by Federal Reserve Chair Jerome Powell. On the 23rd, we also get the weekly initial jobless claims figure and the preliminary PMI data for June. On the 24th, we get the final University of Michigan sentiment for June, and on the 28th, we get the U.S. consumer confidence reading for June. We move now to our technical analysis. Please note this is gold's 4-hour chart. The sideways motion seems to have extended in the most recent sessions, and the price action seems to be nearing the S1 1830 support. If the price action breaks below the S1, we could be seeing a drop towards the S2 1810 hurdle. In the scenario of an aggressive selling interest, we could also see a more prolonged movement that could engage the S3 1785 hurdle, which was tested only a handful of times in 2022, making it the year's low. For the time being, the price action continues to move within a smaller range, bound by the R1 1865 resistance and the S1 1830 support. Yet, if the market turns bullish, we may see a decisive movement towards the R2 1895 resistance, which has not been tested since the beginning of May. In addition, we also note the R3 1920 level that may be used in a more long-term buying strategy. The RSI indicator below our chart seems to be running across the 46 level, possibly pointing to some selling interest in the short run. In our opinion, the metal continues to move in a sideways motion between the R1 1865 level and the S2 1810 barrier since the 9th of May. These levels could provide guidance for building a buying or a selling trend accordingly.